Understanding Financial Accounting, Part 3, Accounting Entries, Debits and Credits. This is Ken Boyd, the owner of St. Louis Test Preparation. Here is our email address and our phone number. This video continues from Financial Accounting to Income Statements. That's on YouTube already. And Principles of Accounting is the website that we use to pull a lot of the information. It's a good website. Let's do a review of debits and credits first of all. A debit's always on the left-hand side regardless of the type of account. Asset, liability, equity. The left side is positive. A credit is always on the right-hand side. There's a typo there. It should say credit. Regardless of the type of account. Asset, liability, equity. Right side is negative. So a common problem is tying asset, liability, equity as always a debit or always a credit. Debit is left, credit is right. Forget about the type of account it is. The other thing is a normal account balance, a positive balance. When you look at financial statements, it's standard that the number that's listed there is going to be a positive balance for that account. An asset account normally has a debit balance going on the left side. A liability or equity account normally has a credit balance on the right side. I want to switch over to Excel and pull up a spreadsheet that shows our balance sheet. What you see here is the balance sheet that we saw on a prior slide where we have assets, liabilities, and equity. We've got some account balances there, and we also see the balance sheet formula at the bottom. Assets equals liabilities plus equity. And I want to go into a new concept called the T account. And I've got a T account for the cash account here, and I want to point out a couple of things. You'll see it's a T with a line down the middle. On the left in blue we have debit, on the right we have credit. Also, an asset account like cash, a normal balance is on the left, which means a normal balance for cash is a debit. If you see a credit balance, an ending balance that's a credit, that should be reclassified because that would be a negative balance. So we start off with a balance of $5,000. We have some activity during the period. A $2,000 debit, which is an increase. A $1,000 credit is a decrease. So when we add the $7,000 in debits and we subtract the credit, we end up with an ending balance of $6,000. We're going to see later on that this is going to be the standard way of putting accounting activity into a T account. What we have here is the 5 transactions that happened to Claire's catering service in a prior video. Claire has a catering service where she buys food, prepares it, sells it to customers, hires people to serve that food at catering events. 5 entries. Number 1, Claire invests $50,000 in the business. Now this accounting information is presented as entries, and you'll see in the first column we have an entry number. We number all of our accounting entries. We have a memo section where we explain the transaction. Third column from the left, we show the accounts, the account names, and then we have debit and credit. So this is one way of showing accounting entries, transactions in your business. So number 1, she invests $50,000, cash goes up, debit. Her capital account, her ownership of the business goes up. That's a credit. Number 2, buys ovens to use in her business. She has a catering business. She cooks a lot of stuff and she needs some expensive ovens. Fixed assets, ovens or assets, go up by debit, asset account, and cash goes down. These are 2 asset accounts. One goes up and one goes down, which is perfectly fine. Number 3, she buys food ingredients to make food for catering. We consider that inventory in her business. So inventory, an asset account, is increased by debiting. Cash, an asset account, she paid cash, is decreased by crediting. Number 4, she sells food to customers. She hasn't been paid yet, so she has a receivable, which is an asset. We increase it by debiting. And she has revenue or sales. That is a entry as a credit, and we'll find out on the next lesson that revenue is increased by crediting. And finally, she sold some stuff, so she's got to recognize the cost of the stuff that she sold. She's got cost of sales and expense account, which is a debit. We'll explain that later. And her inventory went down $15,000. So to review here, we have accounting entries with the entries numbered. All of these entries are going to end up in the T account that's on this slide. And that's a basic explanation of accounting entries. And in our next lesson, we will go on and show those entries in a T account. That's the end of part 3. You'll find part 4 on YouTube. Here's our YouTube channel, our website for live tutoring and live chat. Thanks for watching. We'll see you next time.